The latest market moves underscore the relentless noise that has shaped the year. The whiplash across markets was a resounding reminder to investors that taking big bets during the thinned holiday trading comes with significant risks. The Federal Reserve rate cut came and went, and with it, the foggy mood from a deep divide within policymakers. Trend-following investors have struggled with erratic patterns and reversals in markets, resulting in negative to flat returns this year. While in broader markets, the historic rally in gold and silver underscores the safety-first theme. Gold ended the week with a 2.4% gain, and silver hit fresh all-time highs. Separately, the seesaw in the riskiest corners of the market was on full display once again. Bitcoin's volatility reflects that trend, even as the OG token ended the week slightly in the green. For the week, oil took the biggest hit. Benchmark Brent crude crashed over 4% to the lowest since May on supply glut fears, and the dollar's downturn seemed to be the new norm. Now, with major assets covered, let's shift focus to the Asia-Pacific stock markets. All year, Asian markets have braced for something big to break. The latest moves knocked some of the year's biggest winners off recent highs as tariff concerns resurfaced. Bond yields have spiked, then tumbled, and then spiked once again. Currencies have swung wildly. For the week, equity benchmarks in China and India showed modest losses, while stocks in Japan and Australia reflected more nuanced gains. In the Americas, Wall Street stocks tumbled as the year's winning AI bets took a hit. The tech sell-off dragged global gauges back from the brink to record highs. Disappointing earnings outlook from Broadcom and Oracle brought the revenue versus investment debate back to the table. The tech-heavy Nasdaq dropped nearly 2% on Friday, easing the week's gain. The S&P 500 fell over 1% after the index closed at a fresh record high on Thursday. However, Canadian and Brazilian benchmarks defied those losses to end the week in the green. Looking across the Atlantic, European markets ended the week mixed. The German DAX gained, while the FTSE and the French CAC showed modest losses. Europe's geopolitical discord and the US on Ukraine-Russia peace talks contributed to anxiety in regional markets. The key lesson as the year nears: market noise can distract from core macro realities. Now, having looked at market moves, let's now turn to the overall economic outlook. In Asia, India remains the best-performing major economy in the world. The latest data underscores the country's solid growth, and the government reforms during Parliament's winter session add to the country's allure. However, forecasts continue to be sour for the rest of the Asian economies. The uncertainty from US President Trump's trade policies is weighing on the region's outlook. In addition, China continues to battle a property recession and a deep deflation from weak demand. In the Americas, the Fed rate cut and mixed messages on the macro front clearly reflect a clouded outlook. Private sector numbers point to increased layoffs and a sharply slowing economic activity. The Fed soothed some nerves but warned of elevated inflation to have a say in 2026. Big Wall Street banks caution that stagflation risks are on the rise. Trump's trade rhetoric extended to other economies in the region, with a negative outlook for Canada and Brazil. In Europe, the standard norm across the region is a muted economic environment. Europe's growth engine, Germany, is struggling to get its manufacturing activity back on track. GDP in the UK contracted for the second straight month in October, with no growth seen since June. France is finding it difficult to close its deep budget hole, but in addition to those concerns, Trump's trade brinksmanship is hurting the economic outlook for the region.